In ancient Rome, commerce thrived. The bustling marketplaces were the heart of economic activity, where people from all walks of life gathered to exchange goods and services. These markets were not just places of trade but also hubs of social interaction and information exchange. The vibrancy of these markets was a testament to the ingenuity and enterprise of the Roman people. People gathered to trade goods and services, from spices and textiles to livestock and grains. The variety of items traded was immense. Merchants and customers haggled over prices, and deals were struck with a handshake. The market was a dynamic environment where fortunes could be made or lost in a single day. This included buying and selling debts. Wealthy individuals and merchants would often lend money to others, and these debts could be traded just like any other commodity. This practice allowed for the flow of capital and credit, which was essential for the growth of commerce and trade. These early forms of trading foreshadowed the stock market. The concept of buying and selling financial instruments, such as debts, laid the groundwork for more complex financial systems that would develop in the future. The principles of risk and reward, investment and speculation were already at play. Venice, a powerful city-state, relied heavily on seafaring merchants. The city's strategic location made it a crucial hub for trade between the East and the West. Venetian merchants were renowned for their daring voyages and their ability to navigate the treacherous waters of the Mediterranean. They sought funding for their voyages. These expeditions required significant capital to finance the ship's crew and provisions. Merchants would approach wealthy investors to secure the necessary funds, promising a share of the profits in return. Investors would provide capital in exchange for a share of the profits. This arrangement was mutually beneficial, as it allowed merchants to undertake ambitious ventures while giving investors the opportunity to earn substantial returns. The risk was high, but so were the potential rewards. This system mirrored the concept of investing in a company for potential returns. The idea of pooling resources to fund large-scale enterprises was a precursor to modern-day stock markets, where investors buy shares in companies with the hope of profiting from their success. These early examples highlight the fundamental principles of the stock market. The desire to invest in promising ventures, manage risk, and share in the profits has been a driving force behind economic activity for centuries. The evolution of these practices has shaped the financial systems we know today. The desire to manage risk and share profits has been a driving force behind trade for centuries. From the bustling markets of ancient Rome to the seafaring merchants of Venice, the seeds of the stock market were sown long ago, laying the foundation for the complex financial systems that drive our world today. During the Age of Exploration, European powers sought new trade routes to the east. This era, spanning from the 15th to the 17th century, was marked by a fervent quest for spices, silk, and other exotic goods. The allure of untapped wealth drove nations to explore uncharted territories, leading to the discovery of new lands and sea routes. These voyages required significant financial backing. The cost of ships, crew, and provisions was immense, and individual merchants often lacked the necessary funds. To overcome this, they sought investments from wealthy individuals and institutions, pooling resources to fund these ambitious expeditions. Merchants began issuing shares in their expeditions. These shares were essentially a promise of a portion of the profits from the voyage. Investors who bought these shares were taking a risk, but the potential rewards were substantial. These shares represented a portion of the potential profits. If the voyage was successful, the returns could be enormous, but if it failed, the investors would lose their money. This system of shared risk and reward was revolutionary for its time. Investors could buy and sell these shares. This secondary market allowed investors to trade their shares before the voyage returned, providing liquidity and spreading the risk among a larger group of people. The price fluctuated based on the perceived risks and rewards of the voyage. News of storms, pirate attacks, or successful trades would cause the value of shares to rise or fall, much like modern stock markets. This system laid the groundwork for modern stock trading. The principles of risk, reward, and liquidity that were established during this period are still fundamental to today's financial markets. The concept of shares in ship voyages evolved into shares in companies. As trade expanded and economies grew, the need for capital led to the formation of joint stock companies, where investors could buy shares in a business venture. these shares represented ownership in a company and its potential for growth. Shareholders had a stake in the company's success and could benefit from its profits, driving the growth of early corporations. This innovation revolutionized how businesses raised capital. By allowing multiple investors to pool their resources, companies could undertake larger and more ambitious projects, fueling economic growth and laying the foundation for the modern financial system. In 1602, the Dutch East India Company was established. It was a powerful trading company that needed substantial capital. To raise funds, they created the first official stock exchange in Amsterdam. The Amsterdam Stock Exchange provided a centralized location for buying and selling shares. This innovation brought transparency and organization to the trading process. The Dutch East India Company's success demonstrated the power of the stock market. It allowed companies to access large amounts of capital for expansion and innovation. When you buy a share of stock in a company, you become a part owner. You have a claim on a portion of the company's assets and profits. The value of your shares can go up or down depending on the company's performance. Stockholders can benefit from dividends. These are payments made by companies to their shareholders, usually from profits. Owning stock provides an opportunity to participate in a company's success. However, it also comes with risks, as the value of stocks can fluctuate. In 1698, the London Stock Exchange emerged. Traders gathered in coffeehouses to buy and sell shares. This informal gathering eventually evolved into a formal exchange. The LSE was officially established in 1801. It quickly gained prominence as a global financial center. Its location in London, a hub of trade and commerce, contributed to its rapid growth. The LSE's rise marked a significant shift in global financial power. It cemented London's position as a leading center for capital and investment. In 1792, a group of New York merchants met under a buttonwood tree on Wall Street. They signed an agreement to trade securities with each other. This agreement marked the beginning of the New York Stock Exchange. The Buttonwood Agreement established rules and regulations for trading. This fostered trust and transparency among traders. This simple agreement laid the foundation for what would become the world's largest stock exchange. It marked the beginning of Wall Street as a financial powerhouse. The NYSE grew rapidly in the 19th and 20th centuries. The Industrial Revolution and the rise of corporations fueled its expansion. The NYSE attracted companies seeking capital from a wide range of investors. The exchange's iconic trading floor became a symbol of American capitalism. Its influence extended far beyond Wall Street, impacting global markets. The NYSE's rise solidified New York City's status as a global financial center. It played a pivotal role in shaping the modern financial system. The 1920s witnessed an unprecedented economic boom in the United States. The stock market soared as investors poured money into stocks. However, this period of prosperity was short-lived. In 1929, the stock market crashed, marking the beginning of the Great Depression. The crash had a devastating impact on the global economy, leading to widespread unemployment and financial hardship. The events of 1929 highlighted the inherent volatility of the stock market. They also underscored the interconnectedness of global markets. The Great Depression exposed weaknesses in the financial system. In response, governments implemented regulations to prevent future crises. The Securities and Exchange Commission, or SEC, was established in the United States. Its purpose was to protect investors and regulate the stock market. Similar regulatory bodies were created in other countries. These regulations aimed to promote stability, transparency, and investor confidence in the wake of the Great Depression. The late 20th century brought significant technological advancements to the stock market. Electronic trading systems emerged, replacing traditional floor trading. Online brokers made investing accessible to a wider audience. Investors could now buy and sell stocks from their homes. High-frequency trading and algorithmic trading emerged, leveraging technology to execute trades at lightning speed. These technological innovations transformed the stock market, making it faster, more efficient, and more accessible than ever before. The stock market continues to play a vital role in the global economy. It serves as a barometer of economic health, reflecting the collective sentiment of investors and the financial community. The ups and downs of the market can influence everything from consumer confidence to government policy decisions. It provides companies with access to capital for growth and expansion. By issuing stocks, companies can raise funds to invest in new projects, research and development, and other initiatives that drive innovation and competitiveness. This access to capital is crucial for both startups and established corporations. It offers individuals opportunities for investment and wealth building. Through the stock market, people can invest in a diverse range of companies and industries, potentially earning returns that outpace traditional savings accounts. This democratization of investment allows more people to participate in the financial markets. Retirement savings such as 401(k)s are often invested in the stock market. These investments can grow over time, providing a crucial source of income for retirees. Financial advisors often recommend a balanced portfolio that includes stocks to help manage risk and maximize returns. The stock market's performance can impact economic growth, job creation, and overall financial stability. When the market is strong, companies are more likely to expand and hire new employees. Conversely, a downturn can lead to layoffs and reduced economic activity. Despite its inherent risks, the stock market remains an essential component of the modern financial system. Market volatility can be challenging, but it also presents opportunities for savvy investors to buy undervalued stocks and benefit from future growth. It continues to connect investors with companies seeking capital, driving innovation and economic progress. The stock market fosters a dynamic environment where new ideas can flourish and businesses can thrive, ultimately contributing to a more robust and resilient economy. From ancient coins to digital tokens, the stock market has always reflected what we value most: trust, risk, and possibility. If you found this journey as fascinating as we did, tap like, subscribe, and let's keep exploring the stories behind the systems that shape our world.